Yardeni is now joining us, President at Yardeni Research. Ed, good to have you. Good morning. Great, as always, speaking with you. Somehow, one is hearing more and more this commentary of higher rates, that rates are headed maybe not higher, but a lot higher. I don't know whether this is kind of consensus speak or something has changed at the margin. What's your sense? We had, JP Morgan's chairman and CEO, Jamie Dimon, here in India, and he spoke with us here at CNBC-TV18, and we asked him this question. And he also seemed to echo that maybe, higher rates are coming, closer to the 7% levels. What's your sense?
Well, I don't think higher rates are coming on the short-term side of interest rates. I think short-term rates have just about peaked. I think where we're having problems is in the bond market. And in the U.S. bond market, the problem is that we've just got much too much supply coming from the Treasury. So the deficit has been large, and all these securities are overwhelming the market at a time when the Treasury is actually reducing its holdings of Treasuries, and the banks are doing the same. So I think we're getting a little bit into a sort of a crazy mode here on thinking about how high rates are going to go. If they go much higher, something is definitely going to break. I mean, we know that the commercial real estate market is already in dire straits, and to see commercial mortgage rates go up any higher is just going to be a killer for that marketplace. So I think at some point the Fed may actually have to consider stopping its quantitative tightening because it's certainly not helping in terms of tightening monetary policy. Monetary policy is no longer just being determined by short-term rates. It's also being determined by long-term rates, and they're being affected by quantitative tightening.
Ed, hi. I'm glad you brought that up. You mentioned commercial real estate. As we look at 4.7% on the 10-year, and if the higher for longer narrative continues, could there be more accidents along the way? Earlier this year, we were speaking about mid-sized U.S. banks. What now? What does it mean for not just the economy, but just the way the interconnects between markets are playing out, banks and markets are playing out at 4.7% yield?
Great question, because it really does hammer to the point of is higher for longer really realistic? The reality is, even if the short-term rates stay at these levels with bond yields disinverting, we're seeing instead of an inverted yield curve, we're seeing a disinverted yield curve with bond yields rising towards the 2-year. And in that kind of scenario, we really are looking at potential cracks in the financial system. And it doesn't really have to be much more than commercial real estate. That's a very important market, and there could be a lot of defaults there. We are seeing some delinquencies on the part of consumers. The corporate sector seems to be in actually pretty good shape, but I'm watching the high yield market, because if I see high yield rates starting to go up, I think that would be another warning sign that rates are just already too high, and that higher for longer just isn't going to be realistic, that we're going to find some reason why interest rates are going to come down sooner rather than later.
Hi, good morning, Mr. Yardeni from here in India. Yeah, I wanted to get your view. You've given us your rationale with regard to the Fed. Maybe they cannot go the distance in terms of hiking rates, but what do you expect? Do you think they still have one more rate hike on the cards? That's point number one. And the second factor, I want to talk about the Indian markets. Everyone's saying September was a weak month globally, with US markets down 3 to 5%. We were up 2%. What's your view on the Indian markets?
Well, I think, first of all, with regards to the Fed, I think they should stop. They have been talking about maybe one more rate hike. What they've really done is they've said, okay, we're probably just about done raising rates, but we're still going to stay restrictive higher and longer, as we've been talking about here. But I think at some point they may want to become less hawkish, because they are taking some real risks with the financial system. That I don't think they want to break the financial system. Meanwhile, the inflation numbers have been behaving pretty well. They've been coming down in a transitory fashion as opposed to a persistent problem. And right ahead here, we're going to see rent inflation coming down. With regards to India, like every country, is dealing with the global economy. It's interesting to see that there's some pickup in China, but China's economy, I think, is going to remain relatively weak. Europe's economy, I think, also is going to remain relatively weak. So the the prospects for the global economy look as though they're going to be fairly slow. But among developed countries, the U.S. I think stands out, and among developing countries, India stands out as a country where there's some excitement, where there's some diversification of businesses, and there's clearly a motivation to increase infrastructure and take advantage of the fact that companies are looking for moving their production from places like China to India.
Oh, absolutely, point taken. Ed, just briefly, if you will weigh in on so this the difference between the U.S. 10-year and the Indian 10-year, the government bond yield, is at the lowest in a long time. Now, the fact is that every year the rupee the rupee here used to depreciate 3, 4, 5%, and expectations were for fairly meaningful annual depreciation. That has come off quite a bit. That expectation is that the rupee will come off sharply. It's come off over the last many years. Now, of course, the government bonds in India are also going to get into the global bond index, the JP Morgan bond index, which will bring in large sums of money on an annual basis, one stock adjustment, and then large sums of money. Is this really a worry like before? The fact that there is, the difference is one of the lowest ever between the US 10-year and the Indian 10-year? Or you think it's different this time?
Well, no, I think that whenever you see some wide divergences on a global basis, you have to pay attention and ask yourself, what are the implications? I think the fact that yields are relatively low in India, especially compared to the United States, suggests that we're doing something wrong here in the United States, and you're doing something right over in India. And what we're doing wrong is we've got excessively stimulative fiscal policy where the economy is already doing quite well, but what's excessive is the deficits and the outlook for the deficits. And we're now finding that the bond market, back in 1983, I coined the phrase bond vigilantes, and now the bond vigilantes have decided that they're not happy with what they're seeing. I think they're okay with monetary policy. Tight monetary policy, bringing inflation down is a good thing, but the vigilantes' job is to do something about problems when the fiscal and monetary policies are out of sync with getting things right. So I think in the current situation, they're very upset with fiscal policy, with the size of the deficit, the size of the auctions.
Okay. Ed, finally, just a word on China as well. I mean, in India, the big narrative here that plays out is that we're big beneficiaries of the whole realignment of supply chains. And we've seen money chase that narrative as well, right? That's been the trade. Sell China, come into India. But do you see that reversing? I mean, the PMI data, for instance, that came out over the weekend, it was above 50 for the first time in many months.
Well, look, I think what we've learned in the United States is that if you get yourself into a debt crisis, it's best to deal with it as quickly as possible. It's best to take the losses, to restructure the assets that are distressed, and to move forward as fast as you can and not let it linger. I think China is going to let their debt crisis, particularly in the property market, linger. So I think it's going to continue to be an overhang on their economy. I wouldn't read too much into 1 month of PMI being slightly above 50. I think while manufacturing may be doing a little bit better, the reality is that they got a lot of their growth from the property market, a lot of their growth from infrastructure that was built with monies that were raised when provincial governments sold land. A lot of that game is over. And so I think the Chinese economy is going to remain under some duress.
Okay, Ed, very quickly, do you have a view on crude?
Excuse me?
On crude oil prices, do you have a view?
Oh, on crude. Yeah, I'm sorry. On crude, I don't think we're going to see the price of oil go up to 100 to 120. If it gets there, I don't think it's going to be there for very long. Every major recession we've had in the U.S. and on a global basis has been associated with rising interest rates and or rising oil prices. Now we've got both of them. Look, the Saudis would like to have the crude oil at $100 a barrel. They need the money for their vision 2030. They want to spend a lot of money on diversifying their economy away from oil. Well, it's nice that they want it, but they may not get it because $100 oil sustainably may just be way too high for the global economy. And so I think we may very well have seen the peak in oil prices here for a while.
Oh, that's good news from an Indian market perspective. Thanks so much, Mr. Yardeni, for stopping by and giving us your take on the markets, equity, bonds, as well as on the commodity markets. For the time being.